Blue Whale fan, what's going on, baby? We are locking in this year, man. Keyword of the year is lock in. It's game time, y'all. Let's go. Guys, I promise you, you're gonna love this video. If it's your first time visiting this channel, I just wanna say thank you for stopping by. My name is Gary. I'm the owner of Blue Whale Financial Services, and my goal is to help you guys learn more about trading with Forex and how to make money in the foreign exchange market. By the end of this video, you'll know the difference between options and Forex trading, how to make money in each market, and which one matches your goals, risk tolerance, and most importantly, your account size. Let's get into it. Let's start with options. Options are contracts that give you the right, but not the obligation to buy or sell a stock at a certain price by a certain date. Each contract controls 100 shares. So let's say you think Apple is about to go from $190 to $200. You could buy 100 shares, that will equal out to about $19,000, or you could buy a call option for $300. Now you control the right to buy Apple at $190, but here's the secret. You're not actually buying shares, you're trading the option itself. That $300 you just spent, that's your max risk. That's called the premium. If Apple rises, that contract could double or triple in value and you never touch the stock. Options equal leverage plus defined risk. Let's go over some quick definitions in options trading. Number one is strike price. This is your target buy sell price. Premium is what you pay to get in. Break even is your strike plus premium. Intrinsic value is real profit, and extrinsic value is time plus volatility value. Now flip it. Let's say you think Tesla is about to tank after earnings. Maybe the hype doesn't match the numbers, or the CEO says something wild on the call. Instead of shorting the stock or borrowing shares, which can get complicated and risky, you just buy a put option. What's a put option? A put option gives you the right to sell a stock at a specific price, even if the stock crashes way below that price. Let me give you an example. Say Tesla is trading at $250 and you buy a 240 put option for $3. That's $300 total, since each contract controls 100 shares. Now imagine Tesla drops to $220 after earnings boom. You've got the right to sell it at $240 while it's only worth $220 in the market. That's a $20 difference, or $2,000 in value on a contract you only paid $300 for. Even if you don't own a single share of Tesla, that put option just skyrocketed and you can sell it for a profit. No shorting, no borrowing, just strategy. The best part, you didn't have to borrow shares, you didn't have to mess with margin or short sell anything. All you did was buy a put contract, and as the stock dropped, your option gained value. Now here's where the real game begins. You can sell options and collect premium up front. Most options expire worthless, so sellers win. Once you get the hang of it, you can combine options to control risk, reduce costs, or profit from movement or stability. Spreads, condors, straddles, covered calls. Now let's go over the PDT rule, which is short for the pattern day trader. The PDT rule states that if you make 4 or more day trades within a 5 business day period in a margin account, and those trades make up more than 6% of your total trading activity, then you're classified as a pattern day trader. What happens if you mark the PDT? If you're flagged the PDT, you must maintain a minimum of $25,000 in your account. If your account falls below $25,000, your broker may restrict you from day trading, meaning you can't open and close the same option positions on the same day. So what are some of the pros of options? High leverage with low capital, advanced risk control, volatility-based strategies, income through selling premium. Now what are some of the cons of options? Complex learning curve, time decay, PDT rule, no 24-hour trading. Now let's talk about Forex, the perfect market for small accounts. Forex stands for foreign exchange, and it's the largest financial market in the world. We're talking about $7 trillion a day in value. In Forex, you're not trading companies though, you're trading currencies. Every trade is a currency pair, Euro USD, GBP JPY, and so on. Think of Forex like a global game of tug of war between two currencies. It's not Apple versus Tesla, it's the US dollar versus the Japanese yen, or the euro versus the pound. Every Forex trade is you betting which side of the rope is going to pull harder. If the euro pulls harder than the dollar, Euro USD goes up. If the dollar pulls harder, Euro USD goes down. You're literally betting which country's economy will outperform the other. Now you may be thinking, what moves a currency? These are some of the most common things that move a currency: interest rates, inflation, job reports, war, oil prices, and real world events. Currencies move in what's called pips. Each pip has a dollar value depending on your lot size. If Euro USD moves 50 pips, you can make anywhere between $50 to $500 depending on your lot size. And the real cheat code that separates Forex is leverage. In Forex, your leverage can be as low as 1 to 1 or as high as 1 to 1,000. Meaning for every $dollar you deposit into your trading account, your broker could let you control up to $1,000 worth of currency. That's like turning $100 into the power to trade $100,000. Let me give you an example. It's like showing up to go fishing with a canoe and a single rod, and your broker hands you a full trawler with nets and sonar. Suddenly, you're not just catching one fish at a time, you've got the power to catch thousands of fish. And that's just like the power of leverage in Forex. And it's a total game changer for small accounts. But here's the catch. Most brokers that offer super high leverage like 1 to 500 or 1 to 1,000 are what we call unregulated brokers. And while the fishing boat might be big, you've got to ask who's watching the waters. So what's the difference between a regulated and an unregulated broker? A regulated broker is licensed and monitored by a government-backed financial agency like the CFTC in the US, the FCA in the UK, or ASIC in Australia. These agencies make sure that broker follows strict rules, keeps your money safe, and doesn't manipulate trades. An unregulated broker, on the other hand, operates without any official oversight. They're not being checked, audited, or held accountable. That means they can offer you a crazy high leverage, easy sign up, and fast deposits, but if something goes wrong, like trade manipulation or frozen withdrawals, you're on your own. So what are some of the pros of Forex? You can start with a very small account, anywhere from $50 to $100. You can trade crypto and indices, no PDT rule. You can trade 24 hours, 5 days a week, and easily react to real world news. Now, what are some of the cons in Forex? Fewer strategy tools, less flexible in sideways markets, can be highly volatile. So Forex and options, which one should I choose? It's not about what's better, it's about what works for you and your account size. Me personally, I started with Forex, I still trade Forex. I think Forex is great for people who have smaller accounts. Once you get to 10,000, 25,000, yeah, if you want to do options, that's on you. But me, I just got Forex. Like, you get what I'm saying? Like, it clicked to me, it made sense. So that's why I stuck with Forex. And it took me about, I'm not gonna lie, it took me about 3 years to really start seeing profits. But after that, man, rocket ships. Guys, if you got value from this video today, smash that like button, hit subscribe, and tune in for the next video. Peace.